Good afternoon, good afternoon, good afternoon. It is Wednesday, April 28th, 2021. I'm Crypto Sonar Joseph. We will be carrying the Powell speech at 2:30 Eastern, so about an hour, or I'm sorry, about 40 minutes exactly from right now. We will also get the minutes as soon as they release those, which will be in 10 minutes. Let's get over to the heat map. Let's see what happened while we were gone off stream. So we've got a lot going on. Most people think that the Fed is going to be unchanged today. We'll see what kind of guidance they give, and we'll go from there. But we've got Google up, Facebook up, Amazon up, AT&T up, ExxonMobil, Chevron up. So everything in energy is up. Credit services, Visa, for earnings is up. PayPal up. MasterCard is up. All those are up. Most of the banks are up with the exception of Citigroup and Wells Fargo, which is down a little bit. But JP Morgan and Bank of America are up. Most of the drug stocks are down with the exception of AbbVie and Pfizer. Netflix is up a little bit. Disney down a little bit. Comcast down a little bit. Again, in about 9 minutes, we're going to have the Fed minutes. Those will be released, and then we'll have those. And then a half hour after that, we'll have Fed Chair Jerome Powell and his press conference. So I'm going to click off of that one because we know that's coming up. We already talked about gas prices hit $4 in California. We talked about earnings. I'm going to leave that up. Fear and Greed Index, that doesn't change. 59 from 58 yesterday. I'm going to leave that going. I got my miner going. What's going on with that? Make sure everything's good here. Still at 1.4. That's good. Built up about $562 and another payout in 2 days. And that is down to, let's see, calculator. So 33.55 minus 865 for electricity is 24.90. Divide into 33.55 minus 1. 74%. So my profit margin on my mining today is at 74% profit. So that's good. We'll close that out. I want to talk about Home Depot, but we'll do that a little bit later after the Fed. Let's see. I'm going to leave that open. Leave this ready to go to carry that. And then we'll have that as well, and we'll close some other things. I'm also waiting for, I don't think, let me see here. That drops tomorrow. Okay, so I'm going to close that off because I don't need that open. Let's get into the markets. While we are gone, we have the Dow Jones Industrial Average is down 152 points and heading south quickly. We have the S&P 500 is now down 0.5 and the NASDAQ is down 20. So everything is basically selling off in anticipation of the Fed. Could be a bull trap. We'll see. Coinbase down 280, Palantir down. Where is my Palantir? There it is. Let me get this symbol correct in order here. Down 8 cents on Palantir for the day. Starting to come back. We'll see if it comes out with a bottom here. ExxonMobil right at $58, still up on the day. I'm going to hold those calls unless something drastic happens with the Fed and we get a major correction. I'm going to hold those darn things, and we'll see what happens with those. Still profitable on the day, but definitely pulled back some due to Palantir trading down 10 cents. So it just took a jump down as well. And so the chart does not look that great because we're breaking new lows here. Not quite still. Low of the day is 23.42. 1, 2, 3, 4 candles since the open. Has it been lower than where it's at right now? So we'll see. Actually, 1, 2, 3, 4, 5, 6, 7, 8 candles lower than where it was on a 3-minute chart. So we'll see if this recovers a little bit before the Fed speak comes out. Some other things going on. AMC down 58 cents. That continued its drop. Got all the way down to 1065. So it's down 5%. GameStop actually up 79 cents now. So they were negative on the day. They were all the way down to 166.03. So 166.03 divided into 178. So they recovered about 6.7% off of its bottom today. So good job by them. Palantir running off the rails a little bit today, down 11 cents. Tesla down 638. We already talked about ExxonMobil being up. Boeing 235.43. This is going to be interesting with the Fed. But the expectation is that you have that, and then you have Biden talking for State of the Union tonight. So it'll be interesting to see what happens. Well, we got 5 minutes. I do want to talk about something else I looked at in between here. No other new houses for sold today. All right. Where is it? Oh, here we go. The Atlantic forecast for hurricanes. So basically, what they're looking at is an active hurricane season. Could get 3 to 5 direct U.S. impacts is what the forecast is for this year. 2020 season was like no other. Not only did it produce 30 named storms, the most on record, but the U.S. suffered 12 direct strikes. So 3 to 5 direct impacts. What you would be looking at to play this, if any, is to start looking to see if the storms stack up. If the storms start to stack up one after the other, coming over from Africa and forming as tropical depressions, then tropical storms, and then hurricanes, depending on where they hit, Home Depot, Lowe's. Home Depot is probably the better play. They do really, really well in those seasons for repair work and stuff like that. So, you can see the basin and where there's a nice picture of a hurricane. So that's kind of what we're looking at. Water temperatures in the Western Gulf were cooler than normal. The official date to the season is June 1st. Named storms have become common in May, and even as early as April. Well, we're almost through April and we haven't had any storms yet. Our biggest concern is the fact that water temperatures across the Atlantic are already warmer than normal over a large part of the basin. So they were above normal for the entirety of the 2020 tropical season. So we'll see. This is where the high pressures start, and then it basically comes in. So it forms up middle of the Atlantic here, a little south of the Azores, comes over from Africa, and then boom, comes over and then shuffles around, just in a big freaking circle. So Home Depot might be the play there. So I was looking at their stock earlier. And again, because of all the repairs in the pandemic, they're right near their 52-week high of 328.83. They next report earnings at May 18th, and you can see the last 3 out of 4, with the exception of last April, or last May, sorry. They exceeded, and they're looking at $297 a share. They came in at $265. Time for that, $318 before that, $402. So $402 for the second quarter last year. We'll see what the guidance is, but that's in the third quarter basically due to hurricanes. So and the pandemic and people doing home repairs at home and everything else. And there we go. Just because I spoke it, now it's going to make a run towards the upside here. So let's take a look at the. Why does this say Palantir? Come on. There we go. Oh, that's weird. Okay. All right. So S&P, we got the VIX, 17.8, up 0.2. That is a 0.8 move for the VIX. So again, we have the. So those are going to be coming out here. We'll have the minutes in just a moment, and we'll see. $10.59. Let's go to it. And reload. How much time we got? 30 seconds. Everything's dumping. Everything is dumping a little bit. We'll keep an eye on those. Let's get the S&P up here. Actually, the NASDAQ, because we'll have it on the other one too. And here we go. Let's see what we got. There we go. There's the bell. Service is unavailable. And of course, the site freezes. Still don't have it. So we'll just keep hitting reload until it shows up. Still not released. Still not released. Still not released. Come on, Fed. Do your job. There's a dump on the NASDAQ. So somebody's got it, but we don't. Thank you, Fed. Appreciate you releasing your stuff on time. All right, so big drop there on the NASDAQ. Let's see the S&P. VIX just jumped up or down. Actually, S&P pulled back a little bit too. Still don't have the minutes. Unbelievable. Government. That is the government for you. All right, let's get CNBC up.
Factors. Some out there playing bingo, some playing the drinking game. There's the first transitory of the day from the Federal Reserve. The risk to the outlook from the virus, the Federal Reserve says, remains, and the Fed will continue to aim for inflation above 2%, continue its $120 billion of monthly asset purchases.
How does CNBC have this and we can't even get it on their own stupid Fed website?
That is indeed upgrading its outlook for the
Here we
economy.
go.
Noting the higher inflation rates that are out there.
422,
once
nothing.
Again, not changing policy in the face of that, or even the policy outlook for the
I'm glad CNBC got theirs from LexisNexis, but we can't even get it off the Fed's own website.
Steve, that would change anyone's view that the first tightening of
Fed funds unchanged.
Easing comes not this year but next year. Is there anything that suggests that?
No, and as you know, Tyler, we take the UV light to the statement to make sure we're not missing any hidden signals. We do a compare and contrast. We do all sorts of decoding of the first letter of each sentence. And no, I don't see that in here.
All right, let me see if I can get it on news here.
My outlook
here
for
we go.
Fed policy based on this statement. I think
it says amid vaccine progress and strong policy support, economic indicators, employment have strengthened.
Comment on the economy being at an inflection point and move that over and say monetary policy as is or should be at an inflection
Unbelievable.
point.
How can we not get
saying so far?
Where are the minutes? How do they have them and we don't?
And want to see the jobs numbers come down, get back
Sometimes.
to where they were before the pandemic, and is ready to imbibe transitory inflation.
Stay right there, Mr. Transitory. And as I bring back Mona Mahajan,
there we go. NASDAQ popping. Everything popping up.
We believe the Fed
all right, so that was risky there.
Try not to make waves at today's
so as it comes up, now everything's going to go up.
You nailed it.
All right, we'll take that.
That's what happened.
We will take that.
Like that.
Nice jump there on ExxonMobil. Let me mute this for now. So we've got it. So it looks like everything's unchanged. Positive on the economy. Positive on unemployment. There goes Palantir. It's coming back. All my options are coming back. That's good because I held through all that. That was risky. I had to decide if was I going to sell or not. And so everything seems to be coming up. Now, what we might get is we might get a bounce back down on these.
Strengthen. We've seen it in areas like retail sales, like the earnings figures we're seeing. GDP growth will come out tomorrow. Unemployment, the jobs report have all been pretty phenomenal. Now, we heard from them last time that they don't want to make any decisions based on forecasts. They really want to see it in the data. Well, now we're starting to see it in the data. So, while this meeting is probably quiet, we're not sure if that can last too much longer.
Unbelievable.
We might start hearing a little bit more about tapering in their summer meetings. So something to think about as we go forward. I do think if this data trend continues, if the economy continues at this pace.
All right, there's a little bit of a dump now. Careful. Yeah, and Palantir pulled back. ExxonMobil pulled back a little bit. Let's get to the S&P. Oops. That's what I want. Still on 30 seconds here. Make it a little bit bigger. Same thing with the VIX. So they match up there. VIX is unchanged now on the day. Let's see your Fed inflation risk. Come on. 10-year yield dropping. 30-year yield dropping. S&P up 1.5 now, but pulled back from 41.97, so down about 10 points from that. NASDAQ still down 12.73, and the Dow down 139, but definitely off of the bottom, which was right before the announcement. Fed to continue 120 billion in monthly purchases. Fed committed to using full range of tools. Getting more now. Let's get this stuff over here. We'll just pull it off of Schwab here. Yeah, this is terrible. That the Fed freaking can't even release their stuff on time, so the rest of us can read it. What is going on here? It's supposed to be released at 2 o'clock. They put it on this one. They didn't put it in their data one. Those idiots. Man, that ticks me off. All right, let's comb it. Tremendous human economic hardship. Sectors most adversely affected. Overall financial conditions remain accommodative, in part reflecting policy measures. Path of the economy will depend significantly on the course of the virus. We're done with the virus here, folks. I got news for you. Achieve maximum employment inflation rate of 2% over the longer run. So committee will aim to achieve inflation moderately above. Here we go. The committee will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time, and longer-term inflation expectations remain well anchored at 2%. The committee decided to keep the target range for the Fed's rate at 0 to a quarter, and especially it will be appropriate to maintain the target range till labor market conditions improve. Consistent with the committee's assessments of maximum employment, inflation has risen 2%. It is on track to moderately exceed 2% for some time. In addition, the Federal Reserve will continue to increase its holdings of Treasury securities by at least $80 billion per month. So that's big news. That's big news as well. They're going to keep purchasing assets, Treasury assets by at least $80 billion, and mortgage-backed securities by $40 billion. So basically, that's $120 billion per month that they're going to keep buying mortgage-backed securities and agency-backed securities. And with that, that's why you see the 10-year, and the 30-year dropping off the cliff here, which should be burr for the market to go up. These asset purchases help foster smooth market functioning. The committee will continue to monitor the implications. Wide range of information. So inflation. And everybody voting for the monetary policy action was everybody. So all of them. So I apologize, I did not have that right off the bat there. Usually I get it from data and or press releases, but they put it under. You go into press releases separately, and it's not there. But you go on their main page, and there it is. So lesson learned on that one. They screwed me this time. All right, so let's take a look. Let's get the Dow. Dow now down 145, so definitely gave everything back that it just gained on a quick pump. Now the NASDAQ pulled back, but again, we're getting back into the range where it was before, so that's actually not that bad. S&P now up 0.5, gave back, but again, we're looking at where it was earlier in the day here today. Let's go to a 3-minute chart. And we're going to carry Powell's comments as well. So here's where we were today. Here's the start of the day. Here's 6:30. So from 6:30 off the bottom, S&P is up 0.5. Now let's look at the SPY. SPY's up 0.02. I had some due diligence here on some Fibonacci retracements that I'd done on this chart. Okay, let's see. ExxonMobil, 58.05. Oh, it's coming back a little bit. Palantir trying to get positive, 23.82. I still hold those. Coinbase climbed back. Look where they're at. Right at $300. Right on the button. Wow. We called that one too. AMC down to only 55 cents now. Was as low as 10.65, so it's recovered about 30 cents. GameStop up $1.04. That one jumped pretty good there. Yeah, off of its bottom of 166.97, so up $1.04 on the day, but up a little bit more than that. If we just take the bottom of this wick right here, up to where we're at, approximate, it's up $11.75 or 7% of where it bottomed today at that 166.03. So big move for them as well. Palantir's been mostly flat. It did go positive, 24.13, 24.17. Tesla down 6.49. ExxonMobil still up above $58. Ethereum 27.34. That's going to cause Ethereum and Bitcoin to continue their climb with talks of inflation and people hedging and using Bitcoin as a store of value. Getting close to we are right at a high on this wick of where we were earlier this morning, right before the market opened. So we are higher than at any point during the trading day. If you take a look at 6:30, here's a 6:30 top of the wick. So since the market opened this morning, Ethereum is up 1% or up $27. So there you go. So that one's looking pretty good there. Apple down, AMD pulled back. I hope you didn't have calls on them or something, or that you got out of those things. It had a huge run up right at the open, and then it does what AMD, as soon as Lisa Su got on CNBC, it started selling off, and that's just what happens with earnings. Again, just unfortunately, she just did not have as dynamic a personality as a lot of other CEOs, but she is a fantastic, one of the best CEOs in tech, in my opinion. One of the best. I just wish she would get a little bit more excited. She had a little bit of excitement there, but then everything trailed off. The stock is down 4.8% off of its pullback, but it's only down 1% on the day after the huge run-up that it had approaching earnings both yesterday and Monday, and going into last week where it bottomed out on the 23rd. From Friday morning on through today, it's had a really nice run. Okay, Microsoft has had some issues. They are down 766. We'll see on that. They beat earnings, but they're still down. So let's look at the averages again. Again, we have Powell coming up at 11:30, and we'll see what he says based on the policy statement that they released. And the policy statement again basically says maximum. They want to aim for maximum employment. They want to aim for an inflation rate of 2%, which is where we're at right now, is what they're saying. I think that's what it said. The committee decided to keep the target rate for the federal funds rate at 0.25% and expects it will be appropriate to maintain the target range until labor market conditions have reached levels consistent with the committee's assessment of maximum employment and inflation has risen to 2% and is on track. So we're not at 2% yet. I don't know, where are we at on inflation? Current inflation rate. I think we don't get that till tomorrow. Well, let's click on this one. "12 months ending March is 2.62% for March. So they want it to stay above 2% so that it can average down to 2% later on in the year. So what's that later on in the year? Summer sell-off, maybe, perhaps? So 2.62% in March. We'll see what they say, because we have... I closed the economic calendar. My bad. Inflation comes out tomorrow. GDP comes out tomorrow, and inflation comes out Friday morning. So 5:30 a.m. Pacific, 8:30 Eastern time, inflation on Friday. But GDP, again, they're forecasting 6.5. That's what the expectation is. We'll see what Powell says on that as we get into his speech here in another 16 minutes or so. So now Dow looks like it's bouncing off the bottom a little bit. NASDAQ had the run up, pulled back, gained support back off of old resistance at 11 o'clock this morning. So about, 15 minutes ago. Or 10 minutes before that. 10:50, I'm sorry. 10:50. So right around there. 10 minutes before the release of the minutes. SPY up 12 cents now. S&P up 1.4. Brent crude 67.22, still up 62 cents. Light crude back below 64, though it topped out at 64.53, so it has definitely pulled back. ExxonMobil $58, it's coming back as well. Palantir still $23.79, so bounced up, but now it's pulling back again. We'll see if that gets up to 24 at the close. I don't know. We still got an hour and a half, right? So we'll see what happens. We'll see what happens with that. What is this? U.S. Mint, the America the Beautiful Quarters program ends soon. Yeah, I don't buy quarters. I buy silver dollars. That's what I buy. Speaking of silver, let's take a look at that. Hey, come here, mouse. All the precious metals are down. Silver down 21 cents. Platinum still above 1,200. Again, that's a magic number there for me. 21.96 it's down. Palladium down $22, and gold 17.75. Let's take gold out to a daily chart. Pull back. Let's go to a weekly. And you see the run up since 2019, right? $1,200 in October 2018. Started 2019. Whoops, where are we at here? Boom. We're about 1282, somewhere around there. And it ran up from there. And then a little bit of a sell-off since the first of the year. 1888. It did get up to back in August. Yeah, August, it got up to 2075. So 1774 on gold. Silver, that's another story. It's the most manipulated metal in the market. Look at those wicks. Manipulation. Yeah, good luck trying to chart this thing too. Anyway, all right, U.S. oil up 52 cents. U.S. steel up 16 cents. So Home Depot running up too. Roblox up 68 cents. Do a 3-minute chart. Forming a new, well, it's trying to figure it out. So, because you can't go back over to here when it first came out. You got to look at what it's done, let's say the last 2 weeks. Lowe's. So I added Lowe's and Home Depot to kind of my watch list. And that's because hurricane season is coming. GM down 55 cents. Ford was down. They're down 4 cents. They report earnings tomorrow or today. Today after the close. Hold on a second. Yeah, they report today after the close, I believe. This back over here. Let's see here. Where'd my other one go? All right, close CNBC. So I'm going to close out of a bunch of stuff so that we don't lag during the Powell meeting. We'll leave the minutes up. We'll leave that ready to go. I'm going to close this one up. Close this. Close this one. Close this one. And earnings whispers. I'm going to close that for now. And I'm going to close the S&P 500 heat map as well. So the only thing we have open is going to be the Fed minutes. And that's some key text there. And we'll have that ready to go. I'm going to close my earnings calendar. And this won't be an issue on next week. I'll have a new laptop on Thursday. So a new graphics card, an RTX 3080, which was very expensive. But you guys are worth it. And I need speedy stuff for my trades. All right, so my Palantir shares, I'm down 85 on those. My options are down $300 today. But my ExxonMobil options are up $2,500 today. So they're doing pretty well. Boeing bounced, by the way. Looks like we were mostly right on that call at the 233 level ish. Go back over here. Right over here, we called it on the third candle here, 233, and it's $3 higher on that. I did not take a position in Boeing though. I've still got my ExxonMobil and my Palantir ones, and my lovely Coinbase hanging out at 300. Why does this guy keep? So Palantir only down 6 cents now. Tesla, ExxonMobil. What are you going to do, ExxonMobil? Ow. Okay. Close this out. And I'm going to close that out. I'm going to turn that off. Actually. Boom, boom, boom. Okay. Ah! My iPad just tanked on me there. Okay, so we'll close that out. I'm going to leave my Street Smart Edge, my Schwab program open. And what I think we'll do is I think we're going to carry the S&P 500 and the VIX, and we're going to do this. I'm going to close this. I'm going to do this. We're going to put this one over here, and we're going to take this one like so, and we'll put this over here, and we'll do half the screen for the Fed and half the screen for the charts. There we go. And that way we'll leave it on a 30-second chart. We'll be able to see any reactions that we have on the S&P versus what goes on. Let me take a look and see if I like the way that looks. Hey, why isn't that full screen? All right, that should work out. And we'll see how I do this. I believe I will be able to. Let me see here.
And we are also the Fed.
Oh.
To learn more about the Federal Reserve, you'll find a wide range of resources on the Board of Governors website at federalreserve.gov.
All right, so we'll listen to their music. I'm going to pause mine. Yep. It looks like I can't go full screen on this. Because if I do this, it'll maximize full screen. I wonder if, let me try something here. I'm going to do this. I'm going to go full screen. Let me go play. I'm going to do this. And I wonder if I can drag this back possibly. Get out of here. All right, so maybe. Hold on. What the heck? What happened there? What happened? Okay, so let me see. Oh, that's weird. Okay, what I want to do is I want to see if this works. Yeah, Yeah, why is it doing that? There, okay, we're getting a little better. Okay. Okay, so because that, okay, so now, all right, I don't know if this is going to work or not. Let's see. If I drag it over here, will it stay? Boom. All right, we got it. All right, so now I think, yeah, I can click on these. I can change these. Yeah, I like that. Let me see what happens when I do this. Okay. Okay. All right. So usually he's over in this range. We'll move this around if we have to. I want to get more symbols, however. Let me see if I can do this here. What the heck? Really? You won't, There we go. That's what I want right there. Yeah, that's what I want. So now I can scroll this up so I can see the NASDAQ, the Dow, my Palantir, my ExxonMobil. Everything I want to see is in one screen. So you have your Dow over here. You have your NASDAQ over here. S&P right here. There's your VIX. And then we can just follow, boing. Oh, I see. So I can't click on it. All right, I gotta leave it right there. And we can stay on the S&P. All right, 3 minutes. I will be right back. Okay, here we go. We have less than a minute to go. 20 seconds and this news conference should kick off. You have the S&P 1.8. The VIX is at 17.6. So S&P is on top. The VIX is on the bottom. And we'll have Chairman Powell right in here somewhere, I think. And then we'll see how that goes. Palantir down 9 cents. ExxonMobil 58.14, so it's going back up. That is good news for me. Let's see here. Fed stays the course, nods to strengthened economic recovery. All right, here we go.
Good afternoon. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Today, my colleagues on the FOMC and I kept interest rates near zero and maintained our sizable asset purchases. These measures, along with our strong guidance on interest rates and on our balance sheet, will ensure that monetary policy will continue to deliver powerful support to the economy until the recovery is complete. Widespread vaccinations, along with unprecedented fiscal policy actions, are also providing strong support to the recovery. Since the beginning of the year, indicators of economic activity and employment have strengthened. Household spending on goods has risen robustly. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also increased. Spending on services has also picked up, including at restaurants and bars. More generally, the sectors of the economy most adversely affected by the pandemic remain weak, but have shown improvement. While the recovery has progressed more quickly than generally expected, it remains uneven and far from complete. The path of the economy continues to depend significantly on the course of the virus and the measures undertaken to control its spread. Since March, progress on vaccinations has limited the number of new cases, hospitalizations, and deaths. While the level of new cases remains concerning, especially as it reflects the spread of more infectious strains of the virus, continued vaccinations should allow for a return to more normal economic conditions later this year. In the meantime, continued observance of public health and safety guidance will help us reach that goal as soon as possible. As with overall economic activity, conditions in the labor market have continued to improve. Employment rose 916,000 in March, as the leisure and hospitality sector posted a notable gain for the second consecutive month. Nonetheless, employment in this sector is still more than 3 million below its level at the onset of the pandemic. For the economy as a whole, payroll employment is 8.4 million below its pre-pandemic level. The unemployment rate remained elevated at 6% in March, and this figure understates the shortfall in employment, particularly as participation in the labor market remains notably below pre-pandemic levels. The economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden have been the hardest hit. In particular, the high level of joblessness has been especially severe for lower wage workers in the service sector and for African Americans and Hispanics. The economic dislocation has upended many lives and created great uncertainty about the future. Readings on inflation have increased and are likely to rise somewhat further before moderating. In the near term, 12-month measures of PCE inflation are expected to move above 2%, as the very low readings from early in the pandemic fall out of the calculation, and past increases in oil prices pass through to consumer energy prices. Beyond these effects, we are also likely to see upward pressure on prices from the rebound in spending as the economy continues to reopen, particularly if supply bottlenecks limit how quickly production can respond in the near term. However, these one-time increases in prices are likely to have only transitory effects on inflation. The Fed's response to this crisis has been guided by our mandate to promote maximum employment and stable prices for the American people, along with our responsibilities to promote the stability of the financial system. As we say in our statement on longer-run goals and monetary policy strategy, we view maximum employment as a broad-based and inclusive goal. Our ability to achieve maximum employment in the years ahead depends importantly on having longer-term inflation expectations well anchored at 2%. As the committee reiterated in today's policy statement, with inflation running persistently below 2%, we will aim to achieve inflation moderately above 2% for some time, so that inflation averages 2% over time and longer-term inflation expectations remain well anchored at 2%. We expect to maintain an accommodative stance of monetary policy until these employment and inflation outcomes are achieved. With regard to interest rates, we continue to expect it will be appropriate to maintain the current 0 to 1/4% target range for the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. I would note that a transitory rise in inflation above 2% this year would not meet this standard. In addition, we will continue to increase our holdings of Treasury securities by at least $80 billion per month and of agency mortgage-backed securities by at least $40 billion per month until substantial further progress has been made toward our maximum employment and price stability goals. The increase in our balance sheet since March 2020 has materially eased financial conditions and is providing substantial support to the economy. The economy is a long way from our goals, and it is likely to take some time for substantial further progress to be achieved. Our guidance for interest rates and asset purchases ties the path of the federal funds rate and the size of the balance sheet to our employment and inflation goals. This outcome-based guidance will ensure that the stance of monetary policy remains highly accommodative as the recovery progresses. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to support the economy for as long as it takes to complete the recovery. Thank you. I'll look forward to your questions.
Here we go.
Thank you, Mr. Chair. First, we'll go to Paul Kiernan.
Hi, Chairman Powell. Thanks for doing this. I guess since I'm first, I'll go ahead and re-up Howard's question from the last press conference. Is it time to start talking about tapering yet? Have you and your colleagues had any conversations to those effect? Thanks.
Thank you. So, no, it is not time yet. We've said that we would let the public know when it is time to have that conversation, and we'd said we'd do that well in advance of any actual decision to taper our asset purchases, and we will do so. In the meantime, we'll be monitoring progress toward our goals. We first articulated this substantial further progress test at our December meeting. Economic activity and hiring have just recently picked up after slowing over the winter, and it will take some time before we see substantial further progress.
Thank you.
Thank you. Janelle at Reuters.
Okay, hi, thank you so much. My question is about what's going on with the virus and what if we don't reach a level of herd immunity per se? So in your scenario, thinking about the outlook in the economy, do you have a model where you might start to still normalize policy, even if there's like a baseline of infections still going on, or how can you talk about how you're weighing those things?
Yeah, so we have to leave questions about herd immunity and what that looks like to the health experts, but I would certainly say that what matters the most to the economic recovery continues to be controlling the virus. The economy can't fully recover until people are confident that it's safe to resume activities involving crowds of people. There may be people who are around the edges of the labor force who won't come back in unless they feel really comfortable going back to their old jobs, for example. And there may be parts of the economy that just won't be able to really fully re-engage until the pandemic is decisively behind us. But we've articulated particular guidance for tapering our asset purchases and for lifting off and raising interest rates. So for asset purchases, we've said that we would continue at the current pace of asset purchases until we see substantial further progress toward our goals. So, and that is what it is, substantial further progress. For interest rates, as I said a moment ago, we want to see labor market conditions consistent with maximum employment. We want to see inflation at 2%, and we want to see it on track to exceed 2%. So those are our tests. We don't have an independent test to do with the virus. I will say, though, as I started with, the path of the virus is going to have an effect on our ability to achieve both of those tests.
Great. Thank you. Gina.
Hi, Chair Powell. Thanks for taking our questions. I wonder if you could talk a little bit about that test for raising interest rates that you just elaborated. You've obviously made it very clear that you want to see improvements in the real economy, in the real data, and not in just sort of expectations data before making that move. But I guess I wonder what happens if inflation expectations were to move up before you see some sort of return to full employment. You know, it seems like a lot of sort of the stability in inflation has been tied to the fact that those have been so low and stable. And I guess I wonder how your reaction would be, or sort of how your reaction to that is how you're thinking about that.
Right. So it seems unlikely, frankly, that we would see inflation moving up in a persistent way that would actually move inflation expectations up while there was still significant slack in the labor market. I won't say that it's impossible, but it seems unlikely. It's much more likely that we would, having achieved maximum employment conditions, we'd also be seeing 2% inflation and be on track to see inflation moving above 2%. They tend to move together. So that's not to say inflation might not move up, but for inflation to move up in a persistent way that really starts to move inflation expectations up, that would take some time. And you would think that it would be quite likely that we'd be in very strong labor markets for that to be happening. If that actually were to happen, though, there's a paragraph in the statement on longer run goals and monetary policy strategy, which says that when the two goals are somewhat in conflict, we weigh various factors, including the time it would take to get back and forth. So it doesn't really tell you what to do, but it tells you that we will weigh those two factors and how far we are away from them and how long it would take to reach them, were we to reach that sort of pretty unlikely state.
Thank you. Steve Leisman.
Thank you. Mr. Chairman, I want to follow up on Janelle's question, and I wonder if you can help us understand better your thinking about how COVID infection rates and the virus calibrate with monetary policy. As you recall, we had a major resurgence in the virus last fall, and I'm wondering, would you need to be assured that there wasn't such a resurgence coming before you began, I mean, for lack of a better term, thinking about tapering? And what kind of comfort level would you need? Would it be something that would be declared from the CDC or the World Health Organization, for example, downgrading the virus from a pandemic before you had the comfort level to reverse course on policy? Thank you.
Yeah, we really have just articulated the goals that I've just mentioned a couple of times, which is substantial further progress toward our goals before we taper. Now, that's very likely for us to achieve that. It's very likely going to be the case that we've also made really significant progress on controlling the virus through vaccination and other. Those two things should more or less coexist. We haven't articulated a separate test for a state of the virus that we'd like to achieve, because we're not experts in that area. We're really focused on the economic outcomes. And again, my guess is that it's very likely, it seems to me, that for us to achieve the economic outcomes we would need to taper or to raise interest rates, we would also have to have made very substantial progress in getting the virus under control. Not necessarily fully under control. There is a possibility, of course, that we will have ongoing outbreaks over the summer, various regional outbreaks, and potentially next winter as well. But we'll be looking for substantial progress toward our goals, substantial further progress toward our goals as we think about tapering asset purchases.
Thank you.
Thank you. Victoria.
Hi, Chair Powell. I wanted to ask, you've talked a lot during this crisis about the need to have a lot of help from fiscal policy and monetary policy to make sure that there's not long-term scarring in the economy. And I was just wondering, given all the policies that have been put in place, do you expect there to still be some long-term scarring? And if so, what are you most worried about? Where are you most worried about that showing up?
So I would say that we were very worried about scarring, both in the labor market, from people being out of the labor market for an extended period of time. The evidence is clear that it becomes much more difficult if you're out for a long time to get back in and get back to the life that you had. Same thing with these small businesses, many of which are the work of generations. Were we going to wipe out many of those unnecessarily? That was a big concern. I would say that so far, here we are in late April of 2021, we haven't experienced that level of scarring either in the labor market or among smaller businesses. So we're not living that downside case that we're very concerned about a year ago. Notwithstanding that, we're a long way from full employment. Payroll jobs are 8.4 million below where they were in February of 2020. We've got a long ways to go. And also, it's going to be a different economy. So we've been hearing a lot from companies that they've been looking at deploying better technology and perhaps fewer people, including in some of the service industries that have been employing a lot of people. It may well be, it seems quite likely, that a number of the people who had those service sector jobs will struggle to find the same job and may need time to find work and get back to the working life they had. These were people who were working in February of 2020. They clearly want to work. So those people are going to need help. And so while I would say we haven't seen really highly elevated levels of unemployment for, up in the teens that we thought we might have for an extended period of time, we've still got a lot of people who are out of work. We want to get them back to work as quickly as possible, and that's really one of the things we're trying to achieve with our policy.
Thank you. Rachel Siegel.
Thank you, Michelle, and thank you, Chair Powell, for taking our questions. The housing market in many American cities is seeing booming prices, bidding wars, and all cash offers well above asking price. And this is happening at the same time that housing is becoming much more expensive for lower income Americans and people who are still struggling from the pandemic. Do you have concerns that there are localized housing bubbles or that there's the potential for that? And what is the Fed doing to monitor or address this? Thank you.
So we do monitor the housing market very carefully, of course. And I would say that before the pandemic, it's a very different housing market than it was before the global financial crisis. And one of the main differences was that households were in very good shape financially compared to where they were. In addition, most more people who got mortgages were people with pretty high credit scores. There wasn't the subprime, low doc, no doc lending practices were not there. So we don't have that kind of thing where we have a housing bubble where people are over levered and owning a lot of houses. There's no question, though, that housing prices are going up, and so we're watching that carefully. It's partly because there's clearly strong demand, and there's just not a lot of supply right now. So builders are struggling to keep up with the demand. Clearly, inventories are tremendously low. We're all hearing those stories. And if you're an entry-level housing buyer, this is a problem because it just is going to be that much harder for people to get that first house, and that's a problem. I mean, it's part of a strong economy with people having money to spend and wanting to invest in housing. So in that sense, it's good. It's clearly the strongest housing market that we've seen since the global financial crisis. And, my hope would be that over time, housing builders can react to this demand and come up with more supply, and workers will come back to work in that industry. So, it's not an unalloyed good to have prices going up this much, and we're watching it very carefully. I don't see the kind of financial stability concerns, though, that really do reside around the housing sector. So many of the financial crack-ups in all countries, all Western countries that have happened in the last 30 years have been around housing. We really don't see that here. We don't see bad loans and unsustainable prices and that kind of thing.
Thank you. Chris Rugaber, Associated Press.
Thank you for taking my question. I wanted to ask about the labor market. You see things such as in the Beige Book, you saw in the Beige Book anecdotes about businesses not able to find workers.
Andy
back
froze.
to the labor market for fear of getting sick, child care concerns, and so forth. Do you see these as also just sort of temporary bottlenecks that won't have much effect on the long-term health of the labor market? How are you thinking about these kinds of issues?
Chris, you were breaking up a little there, but I think I did get your question. So, yeah, I think there are a number of things going on there. The tension between a high level of unemployment and yet many companies saying they can't find, an elevated number of companies saying that they can't find workers. So what's really going on there? It should be a number of different things. They're workers who don't actually have the specific skills that the employers are looking for. There may be geographical differences. It may also be that, for example, one big factor would be schools aren't open yet, so there's still people who are at home taking care of their children and would like to be back in the workforce, but can't be yet. There are people afraid of there are virus fears that are weighing on people, so some people don't want to go back to work. There are also a significant number of people who say they've retired. A large number of people that say that they're retired. Now, it's hard to say whether they will come back in as the labor market strengthens and as COVID, becomes in the rearview mirror in the history books, if you will. So, but clearly there's something going on out there as many companies are reporting labor shortages. We don't see wages moving up yet, and presumably we would see that in a real, in a really tight labor market, and we may well start to see that. I do think, so what will happen, what we saw during the last expansion, and it may be a different expansion, we don't know, but what we saw was that labor supply generally showed up. In other words, if you were worried about running out of workers, it seemed like we never did. The labor force participation held up. People came in the labor force. They stayed in the labor force longer than expected. So my guess would be that you will see people coming back into the labor force, and these jobs will be, the labor market will reach equilibrium. Maybe pay will go up. But I do think that, and I do think also that unemployment insurance benefits will run out in September, so to the extent that's a factor, which is not clear, it will no longer be a factor fairly soon. So my guess is that we'll come back to this economy where we have, equilibrium between labor supply and labor demand. It may take some months, though.
Thank you. Heather Scott.
Quick follow-up.
I'm sorry, go ahead. Go ahead, Chris.
He's got a communist book on his shelf. I think he had a book of Karl Marx.
We lost you, Chris. Let's go on to Heather.
Yep, sorry, dude. Get a better internet connection.
I wanted to ask, you've been hearing, of course, these concerns raised by Larry Summers and others about inflation and the fact that they think the Fed might let things get out of hand with the new policy stance. So my question is, can you tell us what is different this time versus previous periods like in the 60s when inflation got out of control? Why are you confident with the lags in monetary policy that the Fed can get ahead of inflation and make sure it doesn't go too far above the 2% target?
Your question. So I actually have a couple of things I'd like to say about inflation, including addressing your question.
Here we go.
Let me start with just saying that we're very strongly committed to achieving our objectives of maximum permanent employment and price stability. Our price stability goal is 2% inflation over the longer run, and we believe that having inflation average 2% over time will help anchor long-term inflation expectations at 2%. With inflation having run persistently below 2% for some time, the committee seeks inflation moderately above inflation for above 2% for some time. So, with a little bit of context, we're making our way through an unprecedented series of events, really, in which a synchronized global shutdown is now giving way to widespread reopening of economies many places around the world. In the United States, fiscal and monetary policy continue to provide strong support. Vaccinations are now widespread, and the economy is beginning to move ahead with real momentum. During this time of reopening, we are likely to see some upward pressure on prices, and I'll discuss why. But those pressures are likely to be temporary, as they are associated with the reopening process. And an episode of one-time price increases as the economy reopens is not the same thing as, and is not likely to lead to, persistently higher year-over-year inflation into the future, inflation at levels that are not consistent with our goal of 2% inflation over time. Indeed, it is the Fed's job to make sure that that does not happen. If, contrary to expectations, inflation were to move persistently and materially above 2% in a manner that threatened to move in longer-term inflation expectations materially above 2%, we would use our tools to bring inflation and expectations down to mandate consistent levels. And I would say, if I may, that is a principal difference from, we're all very familiar at the Fed with the history of the 1960s and 70s, of course. And we know that our job is to achieve 2% inflation over time. We're committed to that, and we will use our tools to do that. So that's a very different situation than you had back in the 1960s, or many, many differences, actually. Let me talk quickly about the two reasons, two or you can say three, but really two main reasons why we think inflation will move up in the near term. The first is the base effects. 12-month measures of inflation are likely to move well above 2% over the next few months as the very low inflation readings recorded in March and April of last year drop out of the calculation. That process has already started to show up. You saw it in the March CPI reading, and you'll see it later this week in the PCE price data. These base effects will contribute about 1 percentage point to headline inflation and about 0.7 of a percentage point to core inflation in April and May. So significant increases, and they'll disappear over the following months, and they'll be transitory. They carry no implication for the rate of inflation in later periods. So that's base effects. The other big one I would talk about is bottlenecks. So this is what we're seeing in supply chains in various industries, and we're in close touch with all of these industries. You know, the Fed has a network of contacts that is unequaled in businesses and in nonprofits, for that matter, too. So what do I mean by a bottleneck? A bottleneck really is a temporary blockage or restriction in the supply chain for a particular good or goods, something that slows down the process of producing goods and delivering them to the market. We think of bottlenecks as things that in their nature will be resolved as workers and businesses adapt, and we think of them as not calling for a change in monetary policy since they're temporary and expected to resolve themselves. We know that the base effects will disappear in a few months. It's much harder to predict with confidence the amount of time it will take to resolve the bottlenecks, or for that matter, the temporary effects that they will have on prices in the meantime. So, you know, I'll just sum up and say we understand our job, we will do our job, and we are focused, as you've seen, for many years, we've been focused on inflation deviating below 2%, and we used our tools aggressively to keep it back up at 2%. If we see inflation moving materially above 2% in a persistent way that risks inflation expectations drifting up, then we will use our tools to guide inflation and expectations back down to 2%. No one should doubt that we will do that. This is not what we expect, but no one should doubt that in the event, we will be prepared to use our tools.
Yeah.
Thank you. James Politi.
Powell, you said a few weeks ago that it would. Thank you, Chair Powell. You said a few weeks ago that it would take a string of months of job creation of about 1 million to achieve progress towards your goal. Can you define what your definition of a string of months is, more specifically? And on inflation, the FOMC said the rise in inflation we're beginning to see largely reflects transitory factors, as you just described. But why use the word largely? And what are the factors driving higher prices that may not be transitory based on the initial data that you're seeing?
So what is a string? What do I mean by a string? Well, I would say what we have right now is one really good I can tell you what it's not. It's not one really good employment reading, which is what we got in March. We got close to 1 million jobs in March and a very strong labor market reading. And I was just suggesting that we'd want to see more like that. We're 8.5 million jobs below where we were in February of 2020, and that doesn't account for growth in the labor force and growth in the economy, the trend we were on. So we're a long way from our goals. And we don't have to get all the way to our goals to taper asset purchases. We just need to make substantial further progress. It's going to take some time. On largely, you know, there are a bunch of factors. I was really thinking, we were thinking of the base effects and also the energy effects. I wasn't meaning to say there are some real effects. I mean, there are always relative prices going up and down within inflation. You know, there's a basket for CPI or PCE. There are, you know, many factors that go into it. Relative prices are always moving up and down. We think it's very fair to say that the increases we see and frankly are about to see later this week are largely due to base effects. It would have been more contentious to say entirely due to base effects because there are some things that are always going up, and so we just said largely.
I have a question.
Hi, Chair Powell. Thanks for taking our questions. Over the past decade, the Fed has invested significant resources in large-scale bank supervision. It has completely overhauled that approach, and it's even created a special committee that looks horizontally across the largest banks to find common risks. Did the Fed not see that multiple banks had large exposures to Archegos? If not, why not? And then what regulatory changes would you like to see implemented to change that going forward?
Yeah, we supervise banks to make sure that they have risk management systems in place so that they can spot these things. We don't manage their companies for them or try to manage individual risks. In the grand scheme of these large institutions, the Archegos risks were not systemically important or were not of the size that they would have really created trouble for any of those institutions. What was troubling, though, was that this could happen in a business for a number of firms that is thought to carry relatively well understood risks. The prime brokerage business is a well understood business, and so it was surprising that a number of them would have had this, and it was essentially, I believe, the fact that they had the same big risk position on with a number of firms, and they weren't some of the firms were not aware that there were other firms that had those things. I wouldn't say it's in any way an indictment of our supervision of these firms. In some cases, it seems as though there were risk management breakdowns at some of the firms, not all of them, and that's what we're looking into.
Thank you. Nancy Marshall-Genzer.
Hi, Chair Powell. I'm wondering, are you planning to visit the homeless encampment that's near the Fed in Washington that you drive by? Have you been invited? And if you went, what would you be looking to learn there?
You know, frankly, yes, I have not had a chance to do it yet, but I've been very busy. But I will visit. I don't want to visit at a time of a lot of media attention because I don't want that to be part of the story. But I will go visit when it's no longer a news story. And I've met with homeless people many times, a number of times anyway, let's say, and I think it's always good to talk to people and hear what's going on in their lives. What you find out is they're you. They're just us. I mean, these are people who, in many cases, had jobs, and they have lives, and they've just found themselves in this place. It's a difficult problem, though. There are many facets of it, and I'm well aware that this is not something that the Fed has all the tools for.
The Fed should shut up about social issues.
I will do that when the need arises.
That statement alone is causing the S&P 500 to drop.
In the public eye.
Along with the Dow.
Is there anything specifically that you would be looking to learn there?
Who cares if he visits a homeless encampment? Just shut up.
Not really. I mean, I think I know what I'll find there. I think you connect with these people, and what you find is they're like you. That could be
they're all in democratic cities.
Your sister. That could be your kid.
They created
you always
the
feel
problem.
that way in that sort of an encounter, and it just is. It's an important thing to engage in, I think, and I think we bring that understanding into our lives and, frankly, into our work.
Which has nothing to do with monetary policy. So shut up. Stupid question.
Thank you, Hannah Lynn.
Social justice warrior idiots.
Hi, I wanted to ask about digital currency. You've previously said a few times that you think it's important for the U.S. to get a central bank digital currency right rather than be first. But
and
with
Ethereum.
Countries like China moving very quickly on CBDC, I was wondering what you think the risks are of moving too slow on digital currency.
Right. So I think the first thing to say is that we feel an obligation to understand the technology and all of the policy issues very, very well.
Bitcoin.
Central bank digital currencies are now possible, and we're
That'll
going
cause
to see
Bitcoin
some
to
of
go
them
down.
around the world. And we need to understand whether that's something that would be a good thing for the people that we serve. How would it work in our system?
The dollar is backed by the same thing as
There's some
Bitcoin.
very, very
Nothing.
difficult questions to answer, but I think we are engaged in a serious program to understand both the technology and the policy issues. I would say this: we're the world's reserve currency. and that means that the dollar is used in transactions all
Come on,
around
tell
the
us you
world,
own
far
Bitcoin.
more than any other currency. And that's because of our rule of law, our democratic institutions, which are the best in the world, our economy, our industrious people, all the things that make the United States the United States. That's why we're the reserve currency. And of course,
Dollar is a Chuck E. Cheese token, the same as Bitcoin.
The reserve currency. So those are
not
the
backed by
factors
anything
that make us the reserve currency. I'm less concerned that another country might have a digital currency. First, ask yourself the question, does that mean that if you were a company that's doing international business, would you then suddenly start to use that currency to do your international transactions? Or would you still do them in dollars, which is what everyone does? And I'm not so concerned about that. I am really concerned about getting it right. It is a tricky set of questions that we have to navigate in a world where we already have, remember, a highly evolved payment system. We have FedNow and other immediately available funds. Pretty soon, everybody will be able to do what people do in other parts of the world, which is just use their phone to make immediately available payments all the time. It'll be normal. And what would be the role of a central bank digital currency in that kind of an environment? Far more important to get it right than it is to do it fast or feel that we need to rush to reach conclusions because other countries are moving ahead. I mean, the currency that's being used in China is not one that would work here. It's one that really allows the government to see every payment that's used for which it is used in real time. It's much more to do with things that are happening.
He is single-handedly causing a sell-off in Bitcoin,
I think, to do with
which
global,
in turn,
sort of global competition,
will push the S&P down as well.
Thank you, Michael Derby.
All right.
Thank you for taking my question. I wanted to ask you another question about inflation, and it has to do with inflation expectations. A number of different surveys and market indicators are showing, multi-year highs in inflation expectations.
Guitar player.
If that was something that you saw as consistent
paint
with
his
inflation
doors.
outlook, is that something that worries you, or do you see that as maybe the success
He's in an
of
old
the Fed's
apartment.
inflation framework, making it out to the broader public?
Right. Inflation and expectations before the pandemic hit, and here we think of survey, market-based, survey being either households or economists and market-based. You look at all of those, and I would say that they were at the low end of what would have been consistent with a 2% inflation target, particularly our 2% inflation target, which calls for 2% average inflation. So they were at the low end. Inflation expectations actually went down a bit at the beginning of the pandemic, and now they've just moved back up to levels broadly that are where they were in 2018 or in some cases 2014, and I would say more consistent with our mandate. And we want them to be. We want them to be higher and on a persistent basis. We want inflation to run a little bit higher than it has been running for the last quarter of a century. We want it to average 2%, not 1.7%. And for that, we need to see inflation expectations that are consistent with that, really well anchored at 2%. We don't really see that yet, but I would say that break-evens have moved up in a way. Break-evens are based on CPI, of course, but they're now at levels that are pretty close to mandate consistent, whereas before they were below. We monitor inflation expectations very, very carefully, as you would obviously know. So that's where I would say it is.
One small follow-up. Do you have any red lines on inflation readings where if you hit like a certain number on, say, core PC, that would be a trigger response from the Fed?
It doesn't work that way.
Good
inflation
answer.
measures are always
It doesn't
going to
work
be a bit
that way.
volatile. We expect, as I mentioned, we expect core and headline PCE to move up because of base effects. And
GDP tomorrow, inflation, core inflation on Friday morning before the open.
To come in, we don't know how persistent they'll be. We think they'll, it's a matter of when they will pass through, not whether they will pass through. But we
Nobody's
can't
asked about
be
GDP
confident
yet.
about the exact timing of that or the size of them. They don't seem especially large at the moment, but we don't know. I mean, this is all about the reopening of the economy. That's what's happening. We were in a deep hole a year ago, And now with a lot of help from fiscal policy, some additional help from monetary policy, and, you know, a great deal of help from vaccination, we're seeing a strong rebound in activity. And what's happening is demand can be spurred with fiscal transfers and the saved up fiscal transfers and people going back to work and things like that. The supply side will take a little bit of time to adapt. New restaurants will have to be opened. The supply of various inputs into the goods part of the economy will
72% since
brought
March.
back up to speed. And you're seeing some of that. That'll happen over a period of time. Over coming quarters, you'll see some of the bottlenecks resolved, but the last one may not be resolved for some time.
Thank you.
Thank you. Brian Chung.
Brian Chung with Yahoo. Hi, Chairman Powell. Brian Chung with Yahoo Finance. I wanted to ask about financial stability, which is a part of the Fed's reaction function here. It seems like to people on the outside who might not follow finance daily, they're paying attention to things like GameStop, now Dogecoin. And it seems like there's interesting reasons in this market to some extent, also Archegos. So does the Fed see a relationship between low
As an
rates
idiot, all he does is he buys
those
overpriced
things, and
tennis
is there a
shoes.
financial stability concern,
New
from the Fed's
Balance,
perspective?
Nike.
Right, so we
And
look
then
at
catch the
financial
third one.
stability for us is really, we have a broad framework, so we don't just jump from one thing to another. I know many people just look at asset prices and they look at some of the things that are going on in the equity markets, which I think do reflect froth in the equity markets. But really, we try to stick to a framework for financial stability, so we can talk about it the same way each time, and so we can be held accountable for it. So one of the areas is asset prices, and I would say some of the asset prices are high. You are seeing things in the capital markets that,
And he just
that are a bit
took the
far
market
off.
down.
That's a fact. I won't say it has nothing to do with monetary policy, but it has a tremendous amount to do with vaccination and reopening of the economy. That's really what has been moving markets.
Just took it down
a lot
0.25%
in
with
the
that
last few
comment.
months, this turn away
by saying the
from
word
what was a
fraud.
pretty dark winter to now
Look at the
much
volatility.
faster
Look what just happened with the
process
VIX.
and a faster reopening. So that's part of what's going on. The other things though, you know, leverage in the financial system is not a problem. That was
1 minute
one of the
chart.
4 pillars. Asset prices was one. Leverage in the financial system
1 minute chart.
is not an issue. We have very well capitalized large banks.
Back to 30 seconds.
We have funding risks for our large
Back to 30
financial
seconds.
institutions are also very low. We do have some funding risk issues around money market funds, but I would say
And it's just caused Palantir to
they're
go
not
down.
systemic right now.
That just
And
caused
the household
ExxonMobil to
sector
go
is actually in
down.
pretty
Everything
good
just
shape.
went down.
It was in a very
Dow is
good
now
shape
down
as
135
a
on a
relative
big
matter.
dip because of this.
Before the financial crisis, the pandemic crisis hit, there were real concerns, of course, with high levels of unemployment and loss of wages and all that the household sector would weaken dramatically. That hasn't happened. So with the fiscal transfers, money that's on household balance sheets, they're in good shape. You see relatively low defaults and that kind of thing. So the overall financial stability picture is mixed, but on balance, it's manageable, I would say. And by the way, I think it's appropriate and important for financial conditions to remain accommodative to support economic activity. Again, 8.5 million people who had jobs in February don't have them now. And, you know, there's a long way to go till we reach our goal. So that's what I would say.
As a follow-up, you mentioned money market pressures.
Oh,
that the Fed
jeez.
didn't make changes to interest on reserves or excess reserves. What was the
He's gonna
logic
ask some
behind that?
stupid
It seems
question
like
again.
silver has been drifting closer to zero, so just hoping for clarification on that.
Right. So the federal funds rate has been well within target and target range, and money market conditions are fine. We have the ability to use our administrative tools to make sure that remains the case. We do expect further downward pressure on rates through asset purchases and also the runoff in the Treasury General account. But at this point, we didn't see a need to deploy our tools to support rates, and of course we will do so if the need does arise.
Thank you. Jean Young.
Hi, Chair Powell. I wanted to ask a similar question. We are seeing elevated market valuations, and some economists are concerned that the economy might overheat, at least for a period of time. So should the Fed and other regulators be thinking about
tightening capital requirements or extending oversight to the non-bank sector so that financial stability risk stays as low as it has been? Thank you.
So I think capital requirements for banks are, to me, they went up tremendously, really, over the course of the 10 years between the financial crisis and the arrival of the pandemic. And the banks really made it through a real stress test very well, and passed two of our stress tests, and then there's another one that's pending. Capital is in a good place as far as I'm concerned in the banking system. But to your point, what we saw was, so what kind of happened during the pandemic crisis that requires attention? And number one is money market funds and corporate bond funds, where we saw run dynamics again. And we're looking at that. So we're looking at ways, and people around the world are looking at ways to make those vehicles resilient so that they don't have to be, supported by the government whenever there's severely stressed market conditions. It's a private business. They need to have the wherewithal to stay in business and not just count on the Fed and others around the world to come in. So that was that. The other one is treasury market structure. Dealers are committing less capital to that activity now than they were 10 or 15 years ago, and the need for capital is higher because there's so much more supply of treasuries. And so there are some questions about treasury market structure, and there's a lot of careful work going on to understand whether there's something we can do about this. Because the U.S. Treasury market is probably the single most important market in the economy in the world. It needs to be liquid. It needs to function well for the good of our economy and the good of our citizens. So it's not clear where that takes you, but we are taking a careful look, and the Treasury Department is really going to be leading this at Treasury market structure and all of the various aspects of that to make sure that we do have a resilient, strong Treasury market that can work even in difficult times. As you know, at the very beginning of of this recent crisis, there was such a demand for selling treasuries, including by foreign central banks, that really the dealers couldn't handle the volume. And so what was happening was the market was really starting to lose function, and that was a really serious problem, which we had to solve through really massive asset purchases. And so we'd like to see if there isn't something we can do do we need to build against that kind of an extreme tail risk, and if so, what would that look like?
Thank you. Edward Lawrence.
Thank you, Fed Chairman, for the question. So I'm interested in your thoughts. There's so much fiscal help and accommodation from the Federal Reserve. You said today that vaccinations will follow the normal economic conditions, or
this should cause things to go up.
Normal economic conditions later this year. When do you see the economy being able to stand on its own feet, so to speak? And along those lines, with the fiscal spending and the accommodation you talked about with transitory inflation, does more spending need to be injected into the system, or would that affect that transitory nature of the inflation? Thank you.
When will the economy be able to stand on its own feet? I'm not sure what the exact nature of that question is.
Well, what I'm saying is, when do we need to lower the amount of treasuries you're buying, sort of taper off a little bit? When can it stand without having that support from the monetary policy side, and then further the transitory?
Okay, sorry. So we've articulated our test for that, as you know, and that is just we'll continue asset purchases at this pace until we see substantial further progress. And we're going to communicate well in advance of any decision. We're going to let the public know that that's what we're thinking, and so there'll be a lot of warning and that kind of thing. But it's about substantial further progress toward our goals. That's really all it is. It doesn't have any external virus-related specific requirement. Although again, I do think the virus will need to continue to be controlled for us to achieve those economic goals. But it's really the economic goals. Now, your second question, sorry, just say again, I didn't quite get that question.
Yeah, sure. With all the fiscal spending that's happened in the accommodation in it, does the system need more spending, either from the fiscal side or accommodation, or would more spending affect the transitory nature of the inflation and put those upward pressures on inflation long term?
So it's really up to Congress. We're not an advisor to Congress. You know, we don't weigh in on specific fiscal bills or proposals. That's really between elected parties. You know, basically fiscal policy is the province of people who stand for democratic election and win, and they get to make those very difficult decisions, and they get to be accountable to the voters. We didn't do any of that, and we don't have a seat at that table. We don't seek a seat at that table. So that's really something for Congress and the administration to deal with.
Thank you, Greg Robb.
Thank you so much for the opportunity. I wanted to circle back to the housing market. It's just kind of confusing, the question and your answer. You know, the housing market is strong, prices are up, and yet the Fed is buying $40 billion per month in mortgage-related assets. Why is that? And are those purchases playing a role at all in pushing up prices? Thank you.
Yeah, I mean, we started buying MBS because the mortgage-backed security market was really experiencing severe dysfunction, and we've sort of articulated, you know, what our exit path is from that. It's not meant to provide direct assistance to the housing market. That was never the intent. It was really just to keep
That's
that.
what it's doing.
It's a very close relation to the Treasury market, and a very important market on its own. And so that's why we bought, as we did during the global financial crisis, we bought MBS 2. Again, not an intention to send help to the housing market, which was really not a problem this time at all. So, and you know, it's a situation where we will taper asset purchases when the time comes to do that, and those purchases will come to zero over time, and that time is not yet.
Thank you.
Thank you. And for the last question, we'll go to Mike McKee.
Thank you, Mr. Chairman. Since I am last, let me go back to Paul's question, the first question, and ask you whether, not whether you're thinking of tapering, but why you're not.
What does Bloomberg get to reporters?
Markets seem to be operating well. Are you afraid of a taper tantrum, or is it, as one money manager put it, if you get out of the markets, there aren't enough buyers for all of the Treasury debt, and so rates would have to go way up? Bottom line question is, what do we get for $120 billion a month that we couldn't get for less?
So it's really not more complicated than this. We articulated the substantial further progress test at our December meeting, and really for the next couple of months we made relatively little progress toward our goals. And remember, substantial further progress from our December meeting. And then vaccination started to get more widespread. The economy reopened. We got a really nice job report for March. It doesn't constitute substantial further progress. It's not close to substantial further progress. We're hopeful that we will see along this path a way to that goal, and we believe we will, just as a question of when. And so when the time comes for us to talking about it, we'll do that. And but that time is not now. We're not that far. We've had one great jobs report. It's not enough. You know, we're going to act on actual data, not on a forecast, and we're just going to need to see more data. It's no more complicated than that.
Well, if you leave rates where they are, doesn't change anything. But does it change anything if you actually tapered a bit? If you spent less, would you still get the same effect on the economy?
If we bought less, you're very faint. So if someone has a volume, they turn it up. But if we bought less, you know, no. I mean, I think the effect is proportional to the amount we buy. It's really part of overall accommodative financial conditions. We have tried to create accommodative financial conditions to support economic activity, and we did that, and we articulated the tests for withdrawing that accommodation. And we think, So we're waiting to see those tests to be fulfilled, both for asset purchases and for liftoff of rates. And when the tests are fulfilled, we'll go ahead as we've done this before. We did it in the last after the last crisis, and we'll do it we'll do it as those tests are satisfied. We'll do it, and the only thing that will guide us are the tests met? That's what we focused on, is have the macroeconomic conditions that we've articulated, have they been realized? That will be the test for tapering asset purchases and for raising interest rates.
Thank you very much. Take care.
Thank you.
Believe that does it. That's it. All right, folks. There you have it. Fed Chair Powell goes boom. And let's get back into we'll close that one out. There's a statement. Let's hit the S&P 500. And let's get into it and let's look at the reaction. All right, so on the reaction side, what you have here is you have the Dow. And I'm going to go out to a 3-minute chart here. And you'll see right at 11 o'clock, it ran up from the statement. The press conference started, went up, slammed back down again, and we're right back where we were. So the net effect of both the FOMC, Federal Open Market Committee statement, as well as the effect of the news conference by Chairman Powell, is basically no effect whatsoever. So no effect whatsoever. Oh, there's a garbage man. Waiting for him to get here. Oh, it's the recycle guy. They're late today. Usually they used to be at like 7 o'clock in the morning. And now they don't show up till the afternoon. And anyway, I get to watch the garbage man on my security cameras. All right. So the Dow has recovered a little bit, but it's pretty much where it was right before the statement was released. We had a sell-off from about a half hour. There had to be an algorithm program that sold off in anticipation. Because if you look at all the indices about the same time, which we will in a moment, you'll see that sell program kicked in right about 10:35. So 25 minutes before the statement was released, they initiated a sell program on the algorithms to drop the market in anticipation of the statement release. Everything as expected. Everything that we thought was going to happen is exactly what he talked about. That caused it to go up. You had some stupid, at 11:30 the press conference began. You had some stupid questions that brought stuff down. He brought back things in at the end, brought things up. When he's talking about social justice issues over here, this huge drop was accountable to one dumb idiot's question. And the idiot's question was, do you plan to visit the homeless encampment near you? Okay, the guy walks to work or whatever, and somewhere I read like 11 blocks or whatever it is, and he goes by this homeless encampment every day. And somehow this is important to the Federal Open Market Committee. The entire economy of the world relies on us, and her idiot question is, are you going to go visit the homeless encampment? Whether he does or doesn't, he knows it exists, and he says when he's talked to those folks before, they're just like you and me, which is true. I've been on hard times before. I've never been homeless, but a lot of people have. And it doesn't change things, but to ask that question and drag the market down, that question just on its own caused, to the bottom of the wick, about a 0.25 0.23%. So that one question dropped the market 0.25%. Same thing, sell program initiated at 10:35 a.m. Algorithms went to work. Here's your dumb question. Irrelevant question. And then same thing, sell program 10:35. Boom. Same thing, dumb question. less effect on the NASDAQ. So the NASDAQ was up a second ago. Now it's down 95 cents, down $1 now. Let's go to 30 seconds here of what's going on here. Looks like we're just leveling out, basically flat. S&P is basically flat. And the Dow, which was down big time, is only down 109 now. So 33,874, let's see here. 33,874 minus, what's the lower today? 33,805? Yeah, it was 69. So, there you go. So it was down about 170 points at the worst of the day for the Dow. So basically the net effect of the Powell statement is nothing. It's basically flat on everything. Things are selectively down a little bit or up a little bit. Palantir, exactly 0.00 on them. ExxonMobil, 58.12. So here's the deal. Here's the dilly deal. Let's see here. I'm literally 100% flat on my Palantir for the day. We've got those 1,500 shares. They're now down $13.20 because it just dropped a penny. Every penny is $15. Still have one garbage can supposed to be picked up. There we go. I'd like to see it get a pop. I'd like to see it get a pop, run up, so I can sell some shares. That's what I'd like to see. I wasn't as worried about the Fed statement today. It looked like even from the beginning of the day, if we go to a 3-minute chart and we look at the start of today, it was pretty much baked in. Look at that. Just channel bound the entire day, flat day, low volume. Volume today, 19 million only on 40 shares, so it's barely going to do half of what its average 10-day volume is, and it's going to end up possibly flat on the day. We'll see if we get a buy program in. There's more, how do I say this gently? I think there's more risk with Biden today at 9 Eastern, 6 o'clock Pacific for his joint statement to Congress that he's going to be talking about, because that's going to be all about taxes. So my ExxonMobil I'm going to hold. I'm going to hold those. They are exactly at $4,000. Like literally the value of my ExxonMobil 80 calls is $4,000. They're at exactly 50 cents. Let me see what the theta is on that now. Let's see. ExxonMobil. And what's my decay? Yeah, my decay is 5 cents. So I'm going to lose 5 cents tomorrow on these things. And 5 cents on Friday. So 10 cents lower than where they're at right now. So it's going to go from 51 cents to 40 cents. 10 times. I might have some decisions to make here this afternoon. All right, so what do you guys think of the Powell thing? Basically nothing, right? Coinbase, $300, 15 cents away. AMC down 76 cents. Coinbase down $2. GameStop down 50 cents. Palantir down a penny. ExxonMobil 5808. I don't know if they're going to make another run or not today. The only reason stocks fell ahead of the Fed rate decision was because of the sell program that came in 25 minutes before the release of the statement. Is what it is. They initiated a sell program and they executed it right here. Boop. Three minutes. 1, 2, 3, 4, 5, 6. 20-minute program. 25-minute program. 1, 2, 3, 4, 5, 6, 7, 8. 24. 25-minute program. So 3 times 8 is 24. So 2 separate 25-minute sell programs. One at looks like 8:45 maybe, 8:40, and the other one at 10:36. Prove me wrong. Anyway, S&P is now up 4.6. I'm going to go to the 3-minute chart. S&P up 4.6. NASDAQ down 5. Let me turn the Bollinger Band off. A little noisy. Where's my volume? Where'd my volume go? Why is volume not working? Oh, idiot. Because it's on an index. I was like, where's my volume? There's no volume on an index. All right, AMD pulling back 89 cents. Again, I hope if you had any of that you got out of it. Palantir up 2 cents. There we go. We'll take that. That should have me profitable on the shares. Shares are going to basically be a wash. Let's see here. Stock. So, what do I think is going to happen? Well, the Biden speech, unusual options activity. All right, let's see here. Okay. All right. So I think that's going to do it for today because we're pretty flat here. I got some things I got to get going on. So we're going to do that and probably end the stream here. Dow down 97. NASDAQ up 2. S&P up 5.8. Watch out for Biden. Market's probably going to go a little bit. Be prepared for that. Take appropriate action or don't. Oil up 63 cents. And light crude up 93 cents to 63.87. And I don't think that there was any other, let's see. Major Chinese investors are in negotiations to purchase a stake in Saudi Aramco. Oil, crude stocks edge up. Distilled inventories drop. Goldman sees surge in oil demand. OPEC Plus sticks to plan to ease oil output. OPEC sticks to plan to increase oil production from May 1st. Basically, that's what that says. Amazing how they got the exact same words, except now it's markets up versus before. Okay, so we're going to end it on that. Boeing 236.47. If you got in at that bottom that we talked about down here at 233, good for you. It's up $3. ExxonMobil, nice day today, up $1.81. Palantir now up 4 cents. Looks like it might be making a little bit of a run here towards the close. Be careful with your overnight holdings, folks. Be very careful. All right, so with that, that is going to do it for today's stream. I'm going to head outside. I got some more stuff to do. Might make a trade here, but I'm going to do it off stream if I do, because I'm going to watch the markets really close. All right, so Dow Jones down 94. The NASDAQ is up 3.3, and the S&P is up 6. That is going to do it for today. We'll see you tomorrow morning before the market opens. Thanks for tuning in. I'm Crypto Sonar. Have yourself a fantastic day and do something nice for somebody. Every single day, try and do something nice for one person. Thanks all. Talk to you tomorrow. Bye now.